Question 1. Which of the following best describes the key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves the reinsurer sharing both premiums and losses in proportion to the cession, while non-proportional reinsurance involves the reinsurer only covering losses above a certain threshold. B. Proportional reinsurance only applies to treaty reinsurance, while non-proportional reinsurance is always facultative. C. Proportional reinsurance is limited to natural disaster coverage, while non-proportional reinsurance is used for operational risks. D. Non-proportional reinsurance involves sharing premiums and losses equally, while proportional reinsurance only covers the loss portion. Answer. Explanation. The key difference between proportional and non-proportional reinsurance lies in how premiums and losses are shared between the ceding company and the reinsurer. In proportional reinsurance, e.g., quota share or surplus share, the reinsurer agrees to share both premiums and losses in proportion to the cession made by the ceding company. For non-proportional reinsurance, e.g., excessive loss or stop loss, the reinsurer only becomes liable for losses that exceed a predetermined threshold, and the reinsurer's participation is typically triggered only after this threshold is surpassed. This distinction is crucial for understanding risk sharing and financial responsibility in reinsurance contracts. Question 2. Mr. Thompson is an insurance broker in Alaska negotiating a reinsurance contract for a property insurer that covers properties in a flood-prone area. Given that Alaska has specific environmental risks, which reinsurance strategy would most effectively help the insurer manage catastrophic flood risks? A. Using a quota share treaty to transfer a percentage of the risk to the reinsurer. B. Implementing excessive loss reinsurance to protect against catastrophic losses exceeding a set amount. C. Relying on facultative reinsurance for each flood claim to be handled individually. D. Using a surplus share treaty to handle excess losses on large properties only. Answer. B. Explanation. In scenarios where the insurer faces catastrophic risks, such as flooding, non-proportional reinsurance mechanisms like excessive loss reinsurance are typically the most effective. Excessive loss reinsurance protects against high-loss scenarios where the reinsurer is responsible for covering losses above a predefined threshold. This is particularly relevant for flood-prone areas where losses can be significant and unpredictable. Quota share or surplus share would not provide the necessary protection for catastrophic events since these are proportional arrangements. Facultative reinsurance, while potentially useful for individual large claims, would not provide the systematic coverage needed for widespread catastrophic events. Question 3. Which of the following statements is true regarding the reporting and compliance requirements for reinsurers under Alaska state regulations? A. Reinsurers are not required to report their financial position to the Alaska Department of Insurance unless they operate in more than one state. B. The reinsurer's financial strength must be assessed based on the statutory accounting principles (SAP) used by the ceding insurer, not the generally accepted accounting principles (GAAP). C. Reinsurers are only required to provide information about their claims reserves, not their premium income investments. D. Reinsurers must file annual reports with the Alaska Department of Insurance regardless of their market participation size. Answer. B. Explanation. Under Alaska state regulations, reinsurers must adhere to the statutory accounting principles (SAP) when reporting their financial position. This is required to ensure that the reinsurer's financial strength and solvency are accurately assessed, as SAP takes into account the unique risks and structures of the insurance and reinsurance industries. While GAAP is generally used for public reporting, SAP is the standard for regulated filings in the insurance and reinsurance sectors. Reinsurers must report all relevant financial information, including premium income, claims reserves, and investments, to ensure compliance with regulatory oversight and maintain solvency. The annual reporting requirement applies to all reinsurers operating in the state, regardless of the size of their market participation. Question 4. Which of the following is the primary purpose of the stop-loss reinsurance agreement? A. To cover losses that exceed a predetermined percentage of the ceding insurer's total premiums. B. To provide coverage for losses above a specified threshold, protecting the ceding insurer from catastrophic events. C. To share premiums and losses equally between the reinsurer and the ceding insurer. D. To transfer all risks related to operational losses to the reinsurer. Answer. B. Explanation. A stop-loss reinsurance agreement is a form of non-proportional reinsurance designed to protect the ceding insurer from catastrophic losses. The reinsurer agrees to cover losses that exceed a specified threshold, usually set as a percentage of the ceding insurer's net retained premiums. This type of reinsurance helps protect against extreme unexpected events, allowing the ceding insurer to maintain financial stability in face of large, infrequent losses. Question 5. Which of the following factors is most critical when determining the pricing of reinsurance premiums under a proportional reinsurance treaty? A. The insurer's historical claims data and loss experience. B. The economic performance of the reinsurer's home country. C. The ceding insurer's solvency margin and regulatory standing. D. The reinsurer's willingness to absorb risk without reinsurance support. Answer A. Explanation. In a proportional reinsurance treaty, the pricing of premiums primarily relies on the insurer's historical claims data and loss experience. This helps the reinsurer assess the risk involved and determine an appropriate price for the coverage. The reinsurer uses this data to estimate the frequency and severity of potential losses and to ensure that the premiums collected will cover these losses. While the reinsurer's financial strength, regulatory status are important, they do not directly impact the premium pricing in the same way that the ceding insurer's loss history does. Question 6. Mrs. Lewis is an insurance executive in Alaska. The company she works for has been struggling with high volatility in the catastrophe loss area, and she is considering using parametric reinsurance to manage risks. What would be the primary advantage of parametric reinsurance for the company? A. It uses a fixed payout based on predefined triggers, reducing the uncertainty in claim settlements. B. It covers all losses incurred from the specific catastrophic event, including both direct and indirect damages. C. It guarantees the ceding insurer a fixed premium rebate after a loss event occurs. D. It involves negotiations for each individual claim based on its severity. Answer. Explanation. The primary advantage of parametric reinsurance is that it provides a fixed payout based on predefined triggers, such as the occurrence of an event with a specified intensity, g. an earthquake of a certain magnitude or wind speeds above a set threshold. This reduces the uncertainty surrounding claim settlements and speeds up the payout process. Unlike traditional indemnity-based reinsurance, parametric reinsurance does require a detailed assessment of losses but instead triggers automatic payouts when certain conditions are met, making it a useful tool for managing catastrophic risks. Question 7. Which of the following is true about the role of reinsurance in the Alaska insurance market? A. Reinsurers are not subject to state regulations in Alaska as long as they operate outside the United States. B. The Alaska market is particularly susceptible to natural disaster risks like earthquakes and floods, which influences local reinsurance strategies. C. Reinsurers in Alaska are exempt from compliance with national reinsurance laws due to state-specific regulations. D. Reinsurance agreements in Alaska are limited to facultative reinsurance arrangements due to the state's small insurance market. Answer. B. Explanation. The Alaska insurance market is particularly susceptible to natural disaster risks such as earthquakes, floods, and severe weather, which significantly influences the reinsurance strategies used by insurers in the region. Reinsurers provide coverage for these catastrophic risks to protect insurers from significant financial losses. While Alaska does have specific regulations governing reinsurance practices, reinsurers operate in the state must also comply with national and international reinsurance laws. Facultative reinsurance is not the only arrangement used in Alaska. Treaty reinsurance is also commonly employed to manage widespread risks. Question 8. In reinsurance, the loss ratio is most commonly used to evaluate which of the following: A. The profitability of the ceding insurer based on premium income. B. The effectiveness of a reinsurance treaty and managing claims experience. C. The solvency margin of the reinsurer. D. The frequency of reinsurance claims settlement. Answer. B. Explanation. The loss ratio is a key metric used in reinsurance to evaluate the effectiveness of a reinsurance treaty in managing claims experience. It is calculated by dividing the amount of claims paid out by the premiums collected. A high loss ratio indicates that the insurer or reinsurer has paid out a significant portion of the premiums in claims, which could signal an ineffective treaty or higher than expected losses. On hand, a lower loss ratio may indicate better risk management and profitability in the reinsurance arrangement. Question 9. Which of the following is a common use of facultative reinsurance? A. To cover risks that are deemed too small or insignificant to be included in a treaty reinsurance agreement. B. To provide coverage for individual large risks or unusual exposures not covered under a treaty. C. To automatically cover losses from natural disasters like hurricanes or earthquakes. D. To allow the reinsurer to set its own pricing based on the ceding insurer's overall portfolio. Answer: B. Explanation. Facultative reinsurance is typically used to cover individual large risks or unusual exposures that may not be adequately addressed under a treaty reinsurance agreement. The ceding insurer can negotiate with the reinsurer on a case-by-case basis, allowing for tailored coverage for specific risks that fall outside the scope of the standard treaty arrangement. This is especially useful when dealing with unique, high-value, high-risk assets that do not fit into the broader treaty structure. Question 10. When evaluating a reinsurance company's financial strength, which of the following factors is least likely to be considered by regulators? A. The reinsurer's ability to meet its obligations under the reinsurance contracts. B. The reinsurer's credit rating and history of claim payments. C. The reinsurer's geographical diversification and market size. D. The reinsurer's pricing models and underwriting guidelines for specific risks. Answer: D. Explanation. Regulators primarily focus on factors that directly influence a reinsurer's ability to meet its obligations, such as the financial strength, credit rating, and claims payment history of the reinsurer. Geographical diversification and market size are also relevant to assessing reinsurers' ability to manage risks. However, pricing models and underwriting guidelines, while important for the reinsurer's business strategy, are not typically primary concern for regulators evaluating financial strength. Instead, regulators focus on the reinsurer's overall financial stability and capacity to handle claims and liabilities. Question 11. Which of the following reinsurance mechanisms allows a ceding insurer to transfer a specific portion of its underwriting risk to a reinsurer in exchange for a percentage of premiums? A. Surplus share reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer: B. Explanation. Quota share reinsurance involves the ceding insurer transferring a fixed percentage of its premiums and corresponding losses to the reinsurer. This type of proportional reinsurance is commonly used to help insurers manage their risk exposure by sharing both premiums and losses according to the agreed-upon percentage. It differs from other mechanisms like surplus share, where the reinsurance coverage is triggered once the ceding insurer retention limit is reached. Question 12. What is the key purpose of a loss development factor in reinsurance pricing? A. To account for the expected growth in premiums over the lifetime of the reinsurance agreement. B. To estimate the potential future development of reported claims and the associated costs. C. To predict the number of claims that will be made under a reinsurance treaty. D. To adjust the ceding insurer solvency margin in line with potential losses. Answer: B. Explanation. A loss development factor is a key component used in estimating the future development of reported claims. It helps the reinsurer anticipate how claims that have been reported but not yet fully settled may evolve over time. This is important in determining the reinsurance premium, as the reinsurer needs to account for both known and potential future claims costs. Loss development factors are typically based on historic claims data and are adjusted for specific characteristics of the ceding insurer's portfolio. Question 13. Mr. Anderson's insurance company is considering entering into catastrophe reinsurance treaty to help manage the risk associated with major earthquakes. What is the primary reason for choosing catastrophe reinsurance in this case? A. To reduce the impact of frequency and severity of earthquake claims on the company's financials. B. To increase the premiums collected by the ceding insurer from the reinsurer. C. To transfer underwriting risks associated with property claims to another insurer. D. To cover smaller, more frequent earthquake losses that do not exceed the policy limit. Answer A. Explanation. Catastrophe reinsurance is specifically designed to protect insurers from large-scale, infrequent, and severe events, such as major earthquakes. The primary purpose is to mitigate the financial impact of these catastrophic events, which can cause significant claims costs that may exceed the insurer's retained capacity. In the case of Mr. Anderson's company, The treaty would help ensure that losses from major earthquake would not devastate the insurer, as the reinsurer would cover the claims above certain threshold. Question 14. Which of the following is a characteristic of facultative reinsurance as opposed to treaty reinsurance? A. Facultative reinsurance automatically covers a group of similar risks, whereas treaty reinsurance covers individual risks. B. Facultative reinsurance involves case-by-case agreements for specific risks, while treaty reinsurance is broader and covers an entire portfolio. C. Facultative reinsurance covers specific losses on a proportional basis, while treaty reinsurance is non-proportional. D. Facultative reinsurance has fixed premium rate, while treaty reinsurance allows for flexible premium negotiations. Answer B. Explanation. Facultative reinsurance involves case-by-case negotiations for specific risks, whereas treaty reinsurance is an agreement that automatically covers an entire portfolio of risks. In facultative reinsurance, the ceding insurer negotiates with the reinsurer on each individual risk, while in treaty reinsurance, the terms apply to a group of similar risks. This gives facultative reinsurance more flexibility, but also requires more administrative effort for each individual risk. Question 15. Which of the following is the primary difference between proportional and non-proportional reinsurance? A. Proportional reinsurance allows for the reinsurer to share both premiums and losses, while non-proportional reinsurance limits the reinsurer's involvement to excess claims. B. Proportional reinsurance does not require premium payment, while non-proportional reinsurance requires both premiums and loss sharing. C. Non-proportional reinsurance applies only to catastrophic risks, while proportional reinsurance applies to everyday claims. Proportional reinsurance focuses on underwriting risk, while non-proportional reinsurance covers operational and credit risks. Answer A. Explanation. The primary difference between proportional and non-proportional reinsurance lies in how premiums and losses are shared. In proportional reinsurance, both premiums and losses are shared between the ceding insurer and the reinsurer based on a fixed percentage (g) in a quota share or surplus share arrangement. Non-proportional reinsurance, such as excessive loss reinsurance, is triggered when losses exceed a certain threshold, and the reinsurer's liability is limited to the amount above that threshold. Question 16. Under the Alaska state regulations, reinsurers must provide evidence of their financial strength before they are licensed to operate in the state. Which of the following would not typically be required by the state for licensing? A. A recent audit of the reinsurer's financial statements. B. Letter from the reinsurer's parent company stating their financial backing. C. Copy of the reinsurer's internal pricing model for its reinsurance treaties. D. Copy of the reinsurer's credit rating from recognized rating agency. Answer C. Explanation. While Alaska state regulations require reinsurers to demonstrate financial strength before being licensed, the state does not typically require the reinsurer to submit their internal pricing models. The primary focus is on financial solvency and stability, which is usually verified through audits, credit ratings, and other financial disclosures. Internal pricing models, while important for the reinsurer's operations, are typically a requirement for licensing. Question 17. Which of the following factors has the least impact on the pricing of a reinsurance treaty? A. The ceding insurer's historical loss ratio. B. The projected risk exposure and potential future claims. C. The reinsurer's desire to undercut competitors in the market. D. The financial strength and solvency of the reinsurer. Correct answer C. Explanation. While a reinsurer's competitive pricing strategy may influence the final premium, the primary factors in determining the price of reinsurance treaty are the ceding insurer's historical loss data, projected risk exposure, and the financial strength of the reinsurer. These factors are critical for ensuring that the treaty is priced appropriately based on the risk involved and the reinsurer's ability to meet future obligations. The reinsurer's desire to undercut competitors, while relevant in some cases, does not have the same impact as these core factors. Question 18. What is a key advantage of using reinsurance to manage catastrophic risk in the Alaska insurance market? A. Reinsurance provides the ceding insurer with immediate claims payments after a loss occurs. B. Reinsurance helps the ceding insurer spread the risk of catastrophic losses over multiple years. C. Reinsurance allows the ceding insurer to transfer catastrophic risks to insurers in other geographical areas. D. Reinsurance helps the ceding insurer to reduce their premiums by covering less risk. Answer C. Explanation. One key advantage of using reinsurance to manage catastrophic risk in the Alaska insurance market is that it allows the ceding insurer to transfer catastrophic risks to reinsurers in other geographical areas. Given the specific environmental risks in Alaska, such as earthquakes and extreme weather, reinsurers located outside of the region may be better able to bear these risks. This spreads the exposure to catastrophic and helps the ceding insurer maintain financial stability. Question 19. Mr. Thompson's company is considering entering into a proportional reinsurance arrangement. He needs to ensure that the reinsurer is financially capable of fulfilling the agreement. Which of the following would be the most reliable indicator of the reinsurer's financial strength? A. The reinsurer's history of successfully paying claims under previous treaties. B. The reinsurer's social media presence and industry reputation. C. The reinsurer's marketing strategies for attracting new clients. D. The reinsurer's internal claims management procedures. Answer A. Explanation. The most reliable indicator of a reinsurer's financial strength is its history of successfully paying claims under previous treaties. This history demonstrates the reinsurer's ability to handle claims obligations, which is a critical component in determining its capacity to fulfill future reinsurance contracts. While other factors, such as reputation and marketing strategies, are important, they do not directly speak to reinsurers' financial strength or ability to meet claims. Question 20. Which of the following best describes a reinsurer's role in managing underwriting risk for an insurer? A. The reinsurer directly manages all claims made by the ceding insurer's policyholders. B. The reinsurer assumes portion of the underwriting risk to reduce the ceding insurer's exposure to large losses. C. The reinsurer only provides support for policyholders who experience catastrophic events. D. The reinsurer sets underwriting guidelines for the ceding insurer's portfolio. Answer B. Explanation. The reinsurer's primary role in managing underwriting risk is to assume portion of the ceding insurer's exposure to large or unpredictable losses. This helps the ceding insurer maintain financial stability and limits its exposure to risks beyond its capacity. The reinsurer does not typically manage claims directly or set underwriting guidelines, although it may provide some guidance in certain cases. Question 21. Which of the following is a characteristic of excessive loss reinsurance? A. It covers a specific percentage of the insurer's premiums. B. It helps insurers manage high-frequency, low-severity risks. C. It provides coverage only for losses that exceed predefined threshold. D. It automatically transfers all premiums from the ceding insurer to the reinsurer. Answer C. Explanation. Excessive loss reinsurance is designed to protect insurers from large, unpredictable losses. The reinsurer's liability is triggered when losses exceed specific threshold known as the attachment point. It is typically used for catastrophic events rather than managing high-frequency, low-severity risks. Question 22. In the surplus share reinsurance arrangement, the reinsurer A retains a fixed percentage of premiums and losses, regardless of the loss size. B accepts a proportion of the risk above a certain retention level set by the ceding insurer. C takes on all of the insurer's underwriting risk, subject to limits. D only covers catastrophic losses, leaving normal losses to the ceding insurer. Answer B. Explanation. Surplus share reinsurance involves the reinsurer accepting a proportion of the risk above a certain retention level set by the ceding insurer. This means that the reinsurer's exposure is limited to the portion of the risk that exceeds the retention limit, providing the ceding insurer with coverage for larger losses while retaining a certain amount of risk. Question 23. Which of the following is the most likely reason for an insurer to use stop-loss reinsurance? A. To share premiums equally between the ceding insurer and the reinsurer. B. To limit the insurer's total losses from specific risk class over defined period. C. To manage the frequency of small claims across large portfolio. D. To provide coverage only for losses caused by specific natural disasters. Answer B. Explanation. Stop-loss reinsurance is designed to limit the total losses an insurer experiences from a specific risk class or portfolio of risks over a defined period. Once losses exceed a predetermined threshold, the reinsurer covers the additional losses, helping the ceding insurer manage aggregate loss exposure. Question 24. What does retrocession refer to in the context of reinsurance? A. A form of primary insurance provided to policyholders who are insured through reinsurance. B. The process by which a reinsurer passes on some of the risk it has assumed to another reinsurer. C. The adjustment of premiums after a claim is settled by the reinsurer. D. The negotiation of reinsurance terms and conditions for a new treaty. Answer B. Explanation. Retrocession refers to the process in which a reinsurer transfers some of the risk it has assumed to another reinsurer. This is done to manage the reinsurer's own risk exposure and financial stability. It is essentially a secondary layer of reinsurance. Question 25. Which of the following is true about facultative reinsurance? A. It automatically applies to all policies in the ceding insurer's portfolio. B. It covers a specific individual risk based on a case-by-case agreement. C. It is generally used for small, frequent losses that can be easily predicted. D. It is a form of non-proportional reinsurance that provides coverage only for catastrophic events. Answer B. Explanation. Facultative reinsurance is arranged on a case-by-case basis covering specific risks rather than applying to an entire portfolio of risks. This type of reinsurance allows the ceding insurer to seek reinsurance for individual, large, or unique risks that may fall outside the scope of their normal treaties. Question 26. Under quota share reinsurance, the ceding insurer and the reinsurer A. Share premiums and losses according to a fixed percentage. B. Only share premiums with the reinsurer assuming no risk. C. Split the risks based on the size of the individual policies. D. Transfer a fixed amount of premiums without assuming any corresponding losses. Answer A. Explanation. Quota share reinsurance is a proportional reinsurance arrangement where the ceding insurer and reinsurer share both premiums and losses according to a fixed percentage. This arrangement helps the ceding insurer manage risk by passing on a portion of the risk to the reinsurer while maintaining a portion of the premiums. Question 27. Which of the following best describes the function of a reinsurance treaty? A. A reinsurance treaty defines the obligations of the ceding insurer and reinsurer, specifying the types of risks covered and terms of coverage. B. A reinsurance treaty is a formal agreement to limit the insurer's liability to policyholders. C. Reinsurance treaty involves only the payment of premiums without coverage for claims. D. Reinsurance treaty is short-term agreement for one specific claim or loss event. Answer A. Explanation. A reinsurance treaty is a long-term agreement between a ceding insurer and a reinsurer that specifies the terms, coverage, and obligations of both parties. The treaty establishes the types of risks covered, the method of premium sharing, and the process for handling claims. It is typically used to manage ongoing risks over an extended period. Question 28. In reinsurance, what is the primary purpose of using a claims-made policy as opposed to an occurrence policy? A. To cover claims that arise only during the policy period, regardless of when the incident occurred. B. To provide coverage for incidents that occur outside the coverage period but are reported within it. C. To offer reinsurance for policies that cover natural disasters and catastrophes. D. To ensure that claims are handled by the reinsurer immediately after they are filed. Answer A. Explanation. A claims-made policy provides coverage for claims that are made during the policy period, regardless of when the incident itself occurred. This is different from an occurrence policy, which covers claims for incidents that occur during the policy period, even if the claim is made after the policy expires. Question 29. In a reinsurance contract, which of the following is an example of moral hazard? A. The ceding insurer increasing its risk exposure because it knows a reinsurer will cover a large portion of the loss. B. The reinsurer offering high premiums to policyholders to reduce underwriting risk. C. The ceding insurer refusing to accept claims from policyholders with high risk. D. The reinsurer diversifying its portfolio to minimize exposure to catastrophic events. Answer A. Explanation. Moral hazard refers to the situation where one party, in this case the ceding insurer, takes on greater risk because it knows that another party, the reinsurer, will bear part of the financial burden. This can lead to an increase in risk exposure for the reinsurer, as the ceding insurer may be less motivated to control risks. Question 30. Which of the following types of reinsurance would be most appropriate for an insurer seeking to protect itself from the financial consequences of a single large claim or catastrophic event? A. Proportional reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Surplus share reinsurance. Answer B. Explanation. Excessive loss reinsurance is the most appropriate type of reinsurance for an insurer seeking to protect itself from the financial consequences of a single large claim or catastrophic event. This type of reinsurance provides coverage for losses that exceed a specified threshold, often used for catastrophic risks like earthquakes or hurricanes.